Oh, welcome into a daily editorial here on the KE Report, chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold. Jordan, I want to follow up on some comments that Dave Erfley and I made in the last interview regarding the chart pattern in, let's say, GLD and even GDX. Dave pointed to the recent moves as head and shoulders being formed and the possibility of, let's say, GDX going back and filling that gap on the daily chart down around 24. What do you have to say about, first and foremost, a number of people pointing to these charts saying a head and shoulders is forming?
Well, I like to do my own analysis. I'm happy to discuss anything, Corey, but it's something that bothers me when people email me and they say, "Oh, well, so and so is saying this. What do you think about that?" Head and shoulders patterns, they show up very frequently. So this is something that shows up often when you're looking at charts, but they don't always play out. And that's because the way a head and shoulders pattern works is you essentially have a market that's been moving up for a really long time. And then there's like a distribution period where it kind of makes, it makes like a mountain-like top, and that's how you get the head and shoulders. You have the head in the middle, and then you have a shoulder on the left, shoulder on the right, and it doesn't always perfectly have to be like that. But if this is a head and shoulders pattern in GDX, like we're not refilling that gap in June. Like we're going a lot lower. We're going down to 21. So if people in our world are pointing out, well, this is a head and shoulders, and GDX is then going down to 21, and it's basically erasing the entire move. Looking at GDXJ, that has a potential top of 43. If there's a neckline of 36, then it's going to go down to 29. So if you really think this is a head and shoulders top, then there's going to be a lot of damage on the downside. We're basically destroying the entire move that we had since May. We're going to retrace 100% of the move. So that's not bullish at all. That would be a 1998 scenario where the Fed just cut once or twice. We had this big pop, and that was it. So if that is the conclusion, if you really think this is a head and shoulders pattern, I think the action is bearish, Corey. I mean, I discussed this in a flash update a couple days ago, where we're having this good rally and it extended. With respect to gold and GDX and GDXJ, and I said this is bullish, especially if we can rally back to the highs, because then we can get more of a sideways consolidation here in the minors. But I did say if that doesn't happen, the other scenario is we probably get a hard reversal at some point to end the week, and it looks like we have that hard reversal today. This is the end of the quarter in the next couple days, so that's also significant. But if you don't get a sideways bullish correction, the other thing that you can get, and this is the most important takeaway from a really long answer, is you get a classic correction where it's down, up, down, where the third leg down goes below the first leg down. So it's not a sideways consolidation. It's more of a correction where you go down, then you go up and you retrace some of it, then you go down to a lower low. So if we're beginning that third leg lower down to a lower low, that means GDX, which had a low in high 26s, maybe 27, it's going to go below that. Maybe it goes to 25. GDXJ, its low's around 36. So the corrective low, the third leg in that simple correction, it's going to go below 36. So that's what I would say. Looking at I don't see a head and shoulders top in gold. I know on the minors it kind of looks like that, but in gold I really don't see that. But at the same time, if we break the lows, let's call them the Fed lows, there is a risk for more selling after we break those lows. So it does look like we could go, just look with respect to the last month or two, there is a threat now that we could go to lower lows, as I noted.
Okay, so that's something to take note of, especially for more of that short-term trader. And you know what? Could be that reason if you do have some money on the sidelines to wait to see where that next bottom is formed. What about some of those short-term bears again who are saying that simply this market is just too overextended? Whether you look at the COT reports and even when you look at still some of those longer-term charts and how fast gold did manage to move up a few $100s, do you share in some of those outlooks?
I mean, we did get overbought, but not super overbought, because if you think about it, Corey, the move that we had, I mean, I know that it did begin at the end of last year, about 12 months ago or 11 months ago, but that move into February was okay. We retraced a good portion of it, but the move since May, it was really not that not that extreme of a move. I mean, looking at the charts, I mean, GDX since the bottom last year, it did go from 18 to about 31, which was a pretty strong move. We've seen stronger moves than this in the past, Corey. I mean, in 2016, the market in the summer of 2016 got a lot more overbought than as it is now. So I've been thinking that miners, they're going to correct and consolidate since hitting that recent top. I mean, you have GDX, you have multi-year resistance at 31, 32. That's going back to 2013. So it doesn't take a rocket scientist or a technical analyst to think that, we hit this strong resistance level, we're probably going to at least consolidate for a few months, several months. So I think that's where we are. We're probably, it's probably going to take some time to digest these recent gains. And look, there is a threat that GDX could go to 25, a strong threat, maybe even 24-ish. So that's where we are. I mean, whether they went too far too fast, that's a whole nother conversation. I mean, look, if the Fed continues to cut rates down, close to zero, we're going to see a massive move higher in this market in 2020. Now, that type of move would dwarf what just happened. Now, if we don't see if the Fed stops cutting rates, and this is like a 98 scenario, then yeah, it'll look like a too far too fast move. So I don't think it's that relevant. I mean, the miners, yes, they had a strong move over a couple months. They got really overbought. They hit strong, multi-year resistance. Same thing with gold. A pullback was to be expected. It's normal.
Exactly. Something that we have been talking about. A pullback is normal. This pullback has been very choppy, though, and that kind of ties in with this volatility we've been seeing. Today's a great example of it the last 2 days, where yesterday gold had a very nice day, moving double digits higher dollar-wise, and then today moving, as we're recording this, it's down about $26. So this volatility has also made for this choppy nature. What do you take away from when we see a market like gold go through this volatility? Because it was only a couple of years ago when we were getting zero moves in terms of percentage moves on a daily or even weekly basis from gold.
Well, the day-to-day volatility going both ways, it just signals to me that we're in a correction. We're in a correction phase that probably will at some point give way to a consolidation phase. And so look, we had gold was in this really long bottoming base since it's crashed in 2013, and it broke out of that base, which was a very significant breakout. So when volatility is dormant for a long time, and you look at these indicators like the gold, I think it's the gold VIX, you look at that and you look at Bollinger Band widths on your charts. I mean, those things were at 5, 10, 15-year lows in some cases. And when we got the big breakout, that brings about much higher volatility. And, we're seeing the effects of that where volatility, it's, maybe not as high as it was a month or two ago, but it's still much higher than it was while momentum and volatility were dormant in the big sense, and we were trading in this long-term bottoming pattern since 2013. So We're in a correction. Volatility is much higher because we had this big breakout. And, that's all that means to me. I don't take any more significance out of that. However, when we're looking at the stock market, volatility there, that sometimes can be a precursor to a bear market. And of course, we get a lot of volatility in stocks, especially on the downside. That's good for precious metals because that means we're going to get more easy policy.
And that is the key driver, I think, right now. And that's one thing that had or got gold breaking out, too, was the easier monetary policy, especially from the Fed. But hey, right now, the Fed might be on pause for a little while. Let's also talk about some other markets. Which markets have your eyes when it comes to also being drivers for the gold market? We're seeing the dollar continue to move higher. We also have the U.S. equity markets that have given up some gain but are bouncing today. Those are also choppy. Yields have gone through a little bit of a rebound. Where is your focus when you're also carrying some analysis back to the gold?
Well, Corey, I'm looking at the gold to the stock market ratio. I wrote an article about this, and I'm not being facetious, but precious metals are not in a real bull market yet until gold outperforms the S&P 500. Now, they did, if you look at the 85 through 87 period, that's really the only time precious metals have had a decent bull market without outperforming the S&P 500. And that's because the dollar went down about 40% during that time. So, it's kind of, there isn't a historical comparison for where we are right now. Now, granted, gold doesn't have that much of a history, like the S&P or like the gold stocks. We can go back further and look how they did when gold was fixed. But again, getting back to my point, it's like gold to S&P 500 ratio, Corey, and gold has to break above that at some point if we're going to get, gold going back to 2000 or even higher, making a new all-time high. That's significant in the bigger sense. Shorter term sense, it's the 2-year yield. It's the proxy for the Fed funds. And, the Fed has now cut their rate down to, I believe, 1.75 to 2%. I'm looking at the 2-year yield as of yesterday is at 1.6. It's probably a little bit higher today. So what does that tell you? The Fed is they're not behind the curve that much anymore. If this 2-year yield rallies up a little bit more, it's going to be right very close to the Fed's target range. And the Fed is not going to cut for a while again, unless we start seeing more weakness in the stock market or the economy. So that's what I'm watching. Also have to watch the yield curve for steepening, because steepening is bullish even if yields both the short and the long end are rising. The dollar is kind of interesting. It's a whole nother conversation. It just keeps going sideways to slightly higher. It's kind of weird, Corey, because I think a higher dollar is more likely to bring about easier policy and lower rates. And, that's more bullish for precious metals. If we were to see the dollar start breaking down, that to me, and we kind of get this reflation theme, that to me is more bullish for commodities, but excluding precious metals. That would be bullish for copper and probably energy. And I did see something interesting. I forget who put it out, but it noted that miners were at 100, they're trading at a 100-year low. However, and this has been making the rounds, Corey, in our business. However, if you read that closely, that means all miners. It's not talking about gold miners. And so that is more. I think that's more around miners that are not gold mining, because it noted like they've performed poorly in the summer. The miners have. That's not the case with gold miners. They performed really well this summer. So if you're looking at commodities and mining excluding gold, that whole sector valuation wise could be where gold was 2015, 2016. So if we get a lower dollar, money is going to flow into those areas first before precious metals. So long story short on the dollar, I think if we get a higher dollar and we get lower yields and interest rates, that is the recipe that's going to be more bullish for precious metals.
All right, Jordan, we're going to wrap it up there. A lot to take in at the end, but you know what? It is all about having or taking a balanced look at the markets, and sometimes it all gets distracting, especially with this volatility that we have had and just how political these markets are. Jordan, great chatting with you. Thanks for taking some time. Everyone, click that link below and go visit Jordan's website, thedailygold.com. Have a great rest of your week there, Jordan.